Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Welcome to another episode of the Trading with Venus podcast. I'm your host, Raman Gill. Today we'll talk about an interesting topic, a measure of success in trading. And one of the things that we have to factor in is the risk to reward ratio. Now, you may have heard a great deal about risk to reward ratios and what's good, what you're supposed to have, what you're not supposed to have. So I thought I will put my 2 cents in the conversation as well. So what is a risk to reward ratio? The risk to reward ratio is basically how much risk you are taking versus how much reward you stand to gain. So when you enter a trade, you want to look at how many pips, where your stop loss is, how many pips away that is, and then you can also calculate the dollar amount as well, right? Now the dollar amount will differ from person to person because each person will have a different account size, so their profit and loss may be different, but that is an important factor that we need to consider. How many pips do you stand to lose when entering a trade, and how much dollar amount you stand to lose when you are entering a trade. And every time we enter a trade, we can't just look at the reward. We do have to look at the risk as well. How much risk are we taking on? So your stop loss will dictate the risk that you're putting on each trade. And on that point, I highly recommend having a stop loss in place. We have had this conversation in my trade room as well, and I've had this conversation with many different people, whether it's a good idea to have a stop loss or not. Now, there are a lot of different ways on going about it, and again, I can talk about this in a different podcast. However, for now, I will say it is important to have a stop loss in place because we as traders tend to be emotional people, and a lot of times people will get carried away when you don't have a stop loss. So it's best to err on the side of caution and just have the stop loss in place. So stop loss will dictate what your risk is, how much risk you're taking. Now, let's talk about reward. What is a reward? The reward would be your take profit target. The level that you place your take profit target gives you your reward side of it. So let's say if you have 10 pip stop loss and 10 pip profit, you have a 1-to-1 risk to reward ratio. And there is no set level as to what your risk and reward needs to be. For a short-term trader, a 10-to-10 may be something that they're looking for, or they're looking for 10 in stop loss and 20 in profit, so you get 1-to-2 risk to reward ratio. Or for somebody who is trading longer term, they may be looking for a stop loss of 100 and they're looking for a take profit of 100 as well. So they have a stop loss and take profit of 1-to-1 ratio where you lose 100 pips and you stand to gain 100 pips as well. Or you may have 2-to-1 reward to risk ratio where you have your stop loss at 100 pips if you're trading longer term, and you have your take profit at 200 pips. So 1-to-2 risk to reward or 2-to-1 reward to risk ratio. So that's fair as well. Now, it really depends on what kind of a trader you are. If you are a longer term trader and you like to let your trades run, you can have that longer risk to reward ratios because your reward will tend to be bigger. And as the trade progresses, you can move your stop loss as well, so that at some point the trade becomes risk free once you have moved your stop to just before your entry. In that case, you have no risk in the trade and anything you have is profit. Now, is this a good measure of success? Now, that, in my opinion, is just something to keep in mind. I do not consider it really a measure of success because risk and rewards can change as trade progresses. For example, let's say you entered a short-term trade, you have a 20 pip stop loss and a 50 pip reward, take profit target. Now your risk to reward is at least 1 to 2, so you have 20 pips in stop and more than 40, 50 pips in your take profit target. From risk to reward ratio, you are good. However, let's say you're sitting in that trade and you're at 30 pips in profit, and all of a sudden a comment comes out, or President Trump makes an announcement saying they're going to put tariffs on China. Now, all of a sudden, the trade that you had 30 pips in turns around, and now you start to lose your pips, so that once you have 30 pips, now it goes to 25, goes to 20. At that point, it'll be best to pull the trade out, right? So let's say you get out with 20 pips. Now your risk to reward ratio is 1 to 1. Even though you started with a really good risk to reward ratio, that can change as the trade progresses, because sometimes it may make sense to pull that trade out even before it reaches your target. Now, you do want to have a good reason for doing that, and this is where you have to keep an eye on your news feed. You have to understand what's going on in the market so that you can make those decisions whether you need to pull out or you need to stay in the trade. For example, let's say you were going on a trip and you had a 100-mile trip. Once you get to, let's say, a 50-mile mark, your idea was that you were going to keep on driving, but let's say your kid really needs to go to the bathroom. And now, even though your reward, your target is 100 miles, but if somebody needs to go, somebody needs to go. And we can't just keep on driving. So this is an example. So you may have to stop, or let's say you were going somewhere and halfway through you remembered that you forgot something. You may have to turn around and come back home to grab that thing. So trading is like that as well. It's dynamic, markets are dynamic, things change, comments come out, sentiment changes. So even though we may have the best of intentions and we're looking for those high risk to reward ratio trades, however, in reality, things do change and we may have to pull out trades quicker. Now, having said that, when we enter the trade, it is important for us to keep the risk to reward ratio in mind, because we don't necessarily want to take trades where our risk is too high, but our reward is not there. For example, if your stop loss is at 40 pips and your take profit is at 20, now you have a negative risk to reward ratio. So that is not a good situation either. So when you're assessing the trading opportunity, you want to take a look at how far is your resistance and how far is your support, so that when you place your stop loss and you want to go put that in regards to the resistance. So let's say you're taking a short trade and you want to put your stop on top of the resistance, you need to measure that distance, and the same way you need to measure the distance to the next support level. And you want it to be at least 1 to 1. 1.5 to 1 is good. Anything more than that is great. However, you do not want to take a trade where your risk to reward ratio is negative. So you don't want to lose more money than you stand to gain. So that's very important to keep in mind. So make sure when you're making a trading decision, you're keeping that in mind. But as you enter the trade, if you have good risk to reward ratio, keep in mind that may change as the trade progresses, because markets do change and news may come out, comments may come out, things may change while you're in the trade, and as a result, you may have to change that risk to reward ratio. So risk to reward ratio is something that's dynamic, and it's an important thing that we have to keep in mind, but in my opinion, it is not a measure of success or failure, because win to loss ratio, I think, is important. A number of pips you made, the P&L that you made, that is more important to keep in mind. Having said that, the risk to reward ratio is a very important thing to consider while you're trading. That's it for today. I hope you enjoyed this episode. If you did, I highly appreciate if you share it with your friends, and thank you so much for spending this time with me. For show notes for this episode, please visit tradingwithvenus.com/podcast page, and I'll be back with you with another episode very soon.
Thanks for joining us today. With much gratitude, your show host, Raman Gill.